It's late October, and the available inventory of homes on the market is still climbing each week. With mortgage rates over 7 or even 7.5% right now, it's not hard to imagine why the market has ground to a halt. Usually by this time of year, we have fewer new listings and some sales still wrapping up, from the summer, so inventory falls. But not this year. There's so little buyer action that even with 20% fewer new supply hitting the market each week, fewer than normal, we still have inventory climbing. Each week, Altos Research tracks every home for sale in the country. We analyze all the pricing, all the supply and demand, and all the changes in that data, and we make it available to you before you see it in the traditional channels. If you aren't using Altos market reports with your clients, your buyers and sellers, now might be the time to step up. Go to altosresearch.com and book a free consult with our team, because everybody is worried about what's happening right now. So they need you to help them see clearly. The data we cover here in these videos is national in scope, but Altos tracks every zip code in the country. So go join us, go to altosresearch.com, and let's do some data together. I'm Mike Simonsen. I'm the CEO of Altos Research, and here's what the data looks like for the week of October 24th, 2022. There are now 572,000 single-family homes on the market. That's an increase of 1% over last week. In August, way back when mortgage rates were closer to 5%, 5.5%, inventory had peaked and had started going down for the year. Then suddenly in September, rates spiked. A move from 5 to 7.5% in a couple of months is so shocking. There's really no precedent anywhere in the data. So you can see at the far right end of this chart, there's a little dip and a little inflection point when suddenly in September, inventory started rising again. So that's where we are now. Regionally, the biggest inventory gains are in Texas, Arizona, and Georgia. Texas looks particularly bad right now. The number of single-family homes on the market in Texas has climbed almost 10% since the beginning of September, when we had that rate super spike kick in, like almost 10%. Significant increase in inventory in Texas. Here is the projection for where we'll end the year. The dark red line here is this year, with the dots are each week for the rest of the year. The modeling kind of breaks down now because inventory never grows this late in the year. There are no inputs into the model that have inventory growing now, but here we are, inventory is growing. So because inventory grew by 1% this week, a full 1%, it's not even flat yet. So we got to expect that it'll keep growing a few more weeks. By Thanksgiving, though, I have to imagine that, even if they're not selling, there's stale listings that get withdrawn and very few new listings. So the active inventory must drop in November, right? I mean, at this point, who knows? You can understand here why the model shows that, though, that inventory must ease down at least a little bit through the end of the year. There are a few other points in here in the model that you can see pretty clearly. You can see the inflection point, September 1, when rates hit that spike, 5.5, over 6, 6.5 very quickly during that first week of September. Rates are significantly higher than that now. So you can see the dotted line expects inventory to fall through the end of the year. Like I said, there are no precedents for inventory to keep rising this late in the year. So even with all those variables, we're looking at about 510,000 single-family homes on the market at the end of the year. Each week that the actuals come in higher than the model, that will inch upward, and if they come in lower, that inches downward. Maybe I'm naive, but it's still hard for me to imagine significantly more than this by the end of the year. But as always, we'll keep watching and we'll revise and report it as soon as we see it. Here's another way to look at these inventory and sales volumes. Even as active inventory rose by 1% this week, the number of homes in contract, the pendings we call them, fell by 2%, more than 2%. So inventory is up and the pendings sales are down. These are the ones that are coming out of pending now are they're started a month ago. They've been in pendings a month or two, and now those sales are getting completed. Some of these are contracts that are failing and people walking away from the deals. So that in this chart, the dark red bars are the count of pendings in a given week. The light red bar is the unsold inventory count. And you could see in the crazy past couple of years, we had more homes pending contract than were available to buy, available on the market. So when rates were 3%, Americans were buying everything in sight. Now, very few new pendings in a given week, a third fewer than last year at this time, going into contract in a given week. Very few homes are getting offers and selling. So 340,000 single-family homes are in contract right now, with only about 54,000 that are new into that pending state this week. Last year at this time, almost 80,000 single-family homes went into contract each week. So you can see significantly fewer going pending. You can see prices ticked back this week too. The median price of single-family homes in the U.S. is now $429,000, give or take. I've mentioned previously that we should expect this number to fall back closer to $400,000 by the end of the year. In the first few weeks of January, that's when it'll be the most telling. So if we start the year with rates in this same 7 to 8% range, then the normal price increases that typically start the year, they won't materialize. So it's looking bearish for home prices for the whole of 2023. When rates had settled in around 5.5%, we could see buyers and price support. But it's really hard to imagine that with mortgage rates at 7 to 8%. I said before that at Altos, we don't forecast mortgage rates. We only measure the market when buyers and sellers react to that macro environment. And we can see that we are so far above that 5.5% threshold where buyers stopped cold. We're now in a place where the macro variables will have to turn dramatically better in order for home prices to stay even flat for 2023. So that's what we got to keep our eye on each week. Price reductions are up too, and they're showing no signs of topping yet. In this chart, you can see September 1, that inflection point, rates where the price cuts had slowed in August, and then promptly with that super rate spike at the beginning of September, demand froze and price cuts resumed. This week, now 42.5% of the market has had a price cut. You can see the dark red line is still trending up here, while the other lines this time of year start to decline. Each line here is a year. This is setting up Q1 to be weak for prices. Normally in Q1, prices climb with the new buying season, but demand right now is so weak that it sure looks like that's going to be very delayed or not even at all the case. We talk about the data a lot in these videos. You may not know that Altos, we also do our Altos Research Top of Mind podcast. In the podcast, it's not just me looking at the data. It's where I'm interviewing leaders and thinkers in and around the industry to learn more than just the numbers. Last week, we talked with Jenny Schutz from the Brookings Institution about housing policy and affordability and how we can fix all the broken things in U.S. housing. This week, I have a fabulous conversation with Nick Timmeros, the chief economics correspondent from the Wall Street Journal. And he's possibly the world's leading journalist covering the Federal Reserve. If you're asking yourself, like, what was the Fed thinking keeping rates so low for so long? And what are they thinking now? hiking rates into a recession? Well, Nick and I discuss exactly that. A lot more too. Anyway, that drops this Wednesday. Get it on the Altos Research YouTube channel. You can hit subscribe here so you get the alerts. It's also a podcast, so it's available wherever you get your podcasts. Okay, that's all the data we have time for this week. More next week.